I want to identify how to pick winning stocks. How do I pick the kind of stocks that will guarantee positive returns at the end of the financial year, that will meet my investment criteria, that will deliver the kind of yield I hope to obtain? Number one, define your goals and as well as your objectives. The very first criteria of picking a winning stocks involve, first of all, defining what your investment goal is. Are you investing to have a comfortable retirement? Do you want to accumulate funds for your children and your grandchildren, creating generational wealth? Do you want to be simply financially free at the end of the day? You want to embark on a larger purchase, like maybe a home or a house or a boat? Do you want to simply cater for your immediate and extended family? Do you want to make provision for your children tuition when they get to college? Whatever your objective is, it's very important you get it down and make sure that it's very, very clear and distinctive. Number two, research the market. Although you're buying stocks, you're picking stocks, but these stocks are embedded within the market. That is why you need to understand the condition of the market. Is the market bearish? It is bullish, or is it in a kind of sideways condition? If the market is bearish, then of course stocks are bound to go down. If the market is bullish, the overall stock prices in the market tend to go higher. And if the market is simply maintaining a sideways situation or condition, then of course those two extremes are not applicable in that circumstance. Number three, identify potential stocks. Before you identify potential stocks you would want to own in your portfolio, you first of all have an investment criteria. What is your criteria? How do you go about identifying these stocks? If I may bring in a personal experience, I've been investing for the past 18 years. I think I've gotten much experience, but little knowledge all the same. Usually, in my own case, I would want the revenue, the turnover, or the sales to double that of what was obtainable in the previous year. The sales must double or more than double. The profits must double or more than double. And more importantly, the earning per share of the company must equally double. And so by so doing, the possibility of a loss in that kind of a stock is somewhat narrow. It's minimal. Then number four, analyze financial health. After identifying those stocks you want to buy, through whatever criteria you want to employ, I've just shared mine with you. You go ahead and analyze the financial health of that company. And how do you go about that? You look at its financial statements. First of all, you take the balance sheet. In the balance sheet, you would analyze and discover whether the assets is more than the liability. If the asset of the company is, let's say, $1 million, for instance, and the liability is, let's say, 50 or 60 or 70 or even 80 million, in that case, the asset far outweighs the liabilities. So in that instance, you will have a greater level of equity. The most important figure here is the equity. The higher the equity, the better for the company, and of course the better for you as an investor. And of course you go ahead and calculate the equity per share. The higher, the better. Number five, you evaluate business models. Evaluate the company's business models. What exactly is the company's business model? Does it have a moat, a kind of protection around itself? Will a change in the environment, the business environment, affect the company or not? If the answer is yes, then of course you may not invest in that company. If the answer is no, you can go ahead and consider it as a viable candidate. Number 6, you assess management. You need to assess critically the management team of the company you want to invest in. More importantly, are they shareholder friendly? That's what you need to consider. Are they truthful in their rendition? Do they have integrity? Do they have the shareholders at heart? Do they treat the shareholders that the way they treat themselves? Then, of course, if the answer is yes, you've gotten an excellent management that will take care of your investments, on your behalf. Number 8, consider valuation. Though the company may report, an increased level of turnover, an increased level of profitability, and also might even double its earning per share, as the case may be. At what price is the company selling at? So what is the company's price compared to its intrinsic value? In other words, the company may have other criteria intact, other matrices intact, but if the price is very high, I would advise you don't buy such a company, except maybe if it's a growth stock. Because at the end of the day, you make your money when you buy, not when you sell. If you buy a stock at a cheaper rate, when you sell, you make a larger profit. If you buy the stock at a very expensive price, when you sell, even if the stock appreciates, you have a minimal level of profit. And so a good company is not always a good investment. It's all a function of the price at which you are buying that particular company. Number 8, or number 9 rather, you look at dividend. How consistent is the company's dividend payout? Have they been regular in paying dividends over the years? If you've been paying dividends regularly, not just regularly, but at an increasing rate, at an increasing payout ratio, then that particular company is a very good candidate for your portfolio. Please, before I continue, I would solicit that you subscribe to this particular channel. It will go a long way in encouraging me to bring along your way contents of this nature, content designed to make you a better investor, to make you free financially, at the end of the day. Give me a thumbs up and also press the notification button. Number 10, review analyst opinion. Although investment in stock market is not a teamwork, you are almost like on your own. But all the same, it's advisable that you consider analysts. These analysts actually are experts in analyzing companies. They are very brilliant, they are very intelligent, they are very smart. And so when they analyze companies, they give a kind of recommendation. It might be a buy recommendation, it might be a sell recommendation, and it might be a hold recommendation. And so if the analyst consensus indicates a buy recommendation, then of course you are safe to go ahead and buy that particular stocks. Then number 11, diversify. You don't just buy stock in a single company, a single stock in a single sector, or a few stocks in a few sectors. No, you need to. The market is inherently risky, in the sense that almost on a daily basis, billions are made and lost in the market. So how do you mitigate that risk? Is through adequate diversification across industries and across sectors, so that a sector not doing particularly well will not affect your overall portfolio result. Then lastly, Number 12, monitor and reassess your investment. You don't just invest in the market and go to sleep. No, you reassess your investment. You rebalance your portfolio. You get it. You buy more of what is doing well and sell more of what is doing less. You rebalance your portfolio as time goes on so as to be able to have a kind of return that could be considered a market beating return. That's how you go about picking winning stocks in the market.